Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our partners at Strategas. Today, I'm thrilled to be joined by Chris Verrone. Chris is a partner at the firm and head of their macro and technical strategy arm. Chris, how are you doing this morning?
I'm doing great, Ross. It's great to be here.
Thrilled to have you on. A lot of moving pieces in the market right now, obviously a lot to get to. I think that's reflected by what you've described as kind of a split market. So some things working really well, a lot of things not working as well. So could you, one, maybe talk through what is and what isn't working, and then maybe your bigger macro takeaway from that story?
Yeah, it's a great question because it is, in fact, a remarkably split tape here. I'm not even sure looking at the index really tells the whole story of what's playing out under the surface. Incidentally, the last several weeks, I've been rereading a very old book called The Alchemy of Finance. George Soros wrote it in, I believe, 1986. And in the middle parts of the book, he offers his personal trading diary from the summer of '86. And he writes about how he's perplexed that he has two very different portfolios on that should never work together, but they're working together. And it reminds me so much of this market today, where you could have on the long tech, long home builders, and long credit book, and that's paying. Or you could have on the short banks, short retail, long gold book, and that's also paying. So I think there's a lot of tension in the macro between what is ultimately the right avenue moving forward. I'm not sure those two very disparate books can exist peacefully forever. I think the market's going to have to make up its mind here. I think in the meantime, we have to focus on relative leadership, and we have to remain very, very selective in where we are. Things like industrials generally still trade well, but I would juxtapose that against parts of discretionary like retail or certainly financials, which really have not rallied here. So very, very split, I think, is still the appropriate adjective to describe this market.
Yeah, I think that's right, and obviously reflects a pretty uncertain macro backdrop at this point, with the banking crisis unfolding right under our feet, the debt ceiling looming. You mentioned long gold, and you all had a note out this morning talking about the copper gold ratio, which copper economically sensitive, usually rallying when the outlook is good, gold a bit more defensive, as a hedge for kind of, big volatility, geopolitical volatility. What is that ratio telling you about the macro outlook that maybe that split tape isn't necessarily conveying?
Yeah, I'll make a couple points first on gold and then kind of what the macro message of gold is. We got lucky with a bullish gold call maybe 6 or 7 months ago. I still have it on. I like the fact that despite how strong gold has been here, if you look at the positioning and the flows, they're really not that aggressive. I get uncomfortable when positions get full or crowded. I just don't think that's the case here with gold. It's the only asset I can really find anywhere, only asset class that's making new all-time highs in spite of this. I think of gold as currency. I think it's the strongest currency in the world here. You've heard a lot about very vulnerable dollar. I think the best way to express that is through long gold. When you think about what the message here is, we look at the ratio between copper, industrial metal versus gold, precious metal, to get some sense on what the market thinks about economic activity moving forward. That ratio has weakened pretty meaningfully here, actually broke down overnight to a new cycle low. Historically, when we have seen the copper gold ratio moving lower, it has generally meant rates sideways to down. Rarely do you get rates up when the copper gold ratio is moving lower. So, looking at this in context of rates, 10-year yields at 330 is a very, very important line in the sand. Any decisive move under there, I think, would really emphasize the bond market's view that the economy is likely to slow from here. But I would also just take note, looking at the shorter end, 2-year yields are some 130, 135 basis points below the Fed funds rate right now. That's an unusual setup. The 2-year yield should not be trading that far below where Fed funds are. When we have seen that historically, it has generally meant more defensive macro and equity leadership.
Right. So a package of indicators that might actually suggest a more negative macroeconomic outlook in the near term. I want to take that and kind of flip it on its head for our final question here, which is, what is something that has you, optimistic about the market, or something, some area of the market that you're excited about right now? Let's end on that.
Yeah, it's a great question because for as many blemishes as there are, there are just as many groups that are acting quite well. We've liked big cap healthcare. I think it generally trades pretty well. I think the industrials as well. It's not a group you would expect to be doing well into a slowdown. But actually, the history is if you look at the group, industrials in 2000, 2001, 2002, 2003, they outperformed actually going into the '01 recession, outperformed during it, and then outperformed coming out on the other side. Home builders did the same thing. They were strong into that recession, during that recession, and coming out. So my suspicion is that neither industrials nor home builders are trading on cyclical concerns right now. They're trading more on secular tailwinds, which is what we've seen from those groups in the past. I would also just note geographically, we remain very impressed with how good Japan acts here. I mean, talk about underowned and not seeing flows very aggressive to that part of the world. I think Japan is probably the most underowned of the global markets. We think it trades great here. I think the end of yield curve control, or the potential end of YCC, keeps domestic money there at home. One of the reasons why we like Japanese equities higher here. And then, lastly, just in terms of searching for positive tones or green shoots out there, I do think from a sentiment perspective, there's something to be said for the fact. I mean, I travel around every week and I talk to equity managers all over the world. I find it a little unusual that equity portfolio managers seem very content taking a 4% yield from a 12-month treasury bill as opposed to going out and searching for real opportunity. That's odd to me. And I do think it's a commentary on what is still pretty defensive sentiment. We like to play a game with ourselves. Look a year out in the future. If the S&P a year from now is at 5,000, right? Why would it be at 5,000? I think one of the catalysts for that could be just how defensive attitudes and positioning here are. Not my base case, but certainly something when we're trying to poke holes in our thesis that we want to be aware of.
Well, we'll end on the green shoots, the optimism. I love it, and we always appreciate the time. Thank you so much for the insights, and hope to talk again soon.
Great to be here. Thanks, Ross.